So I go on Radigan yesterday, and, you know, David Stockman, former budget director for the Reagan administration, he's talking to me in the green room. He's not talking to me. He's talking to Jonathan Alter, but I just sat right there, pretended like I was looking at my my iPhone. I mean, he was sort of, I mean, I introduced myself, but I was pretending like I wasn't listening because, you know, I'm like at the kids' table. Jonathan Alter was nice. We didn't get into an argument this time. He's a perfectly nice guy, and he didn't say anything that, you know, how old are you? But Stockman was there, and Stockman was saying, like, these Republicans, they're like they have a religious fervor about tax cutting. They have no idea what's going on. It's a joke. It's a joke. They're a joke. And he said some of this on the show too. So, and I'm sure he would have said more. He's saying it all publicly, but he's like PIMCO is shorting Treasury bonds, and this is it, man. This is it. He's talking months. Now, what happens? And so I said, well. So they're shorting Treasury bonds, but where are they going to put their money? Well, commodities and this and that. We're going to get inflation, and the Fed after the QE2, this is the quantitative easing. You know, because the Fed's been buying up some of these Treasury bonds, essentially. What they do is they lend money at a very low rate, and then people turn around and they buy Treasury bonds with it. That's the way they make money. It's the easiest scam in the world. And essentially what's going on is the Fed is buying Treasury bonds to maintain their value, which also means that lower interest rates on these things. So he says they're going to stop, which I don't believe that they're going to stop. They're going to keep doing it in one form or another. They'll find some way, whether they announce it publicly or not. And he says, and then nobody's going to buy the Treasury. You know, nobody's going to buy the Treasury bonds. But I said, well, where are people going to park their money where they know they can get it can be safe? And he said, well, commodities. They'll get into more speculative things. And then I said, well, but I don't understand what the problem is. Well, to sell Treasury bonds, they're going to have to increase rates, interest rates, and then we're going to get massive inflation. Now, here's the question I didn't get to ask him on Radigan, because by the time it got to me, it was like I first started with what's more important, jobs or this? And he's like, this! The dirty little secret they don't tell you about is that inflation is not bad for most of us. Obviously, 10, 12% inflation, bad. But we're already seeing the two things that most people pay for inflated: food and fuel. And so if you get inflation on other assets, what you're going to start to see is that you're going to get more money to save. Your mortgage payments are going to be easier to make. Inflation hurts lenders. Who are lenders? They are the banks. They are bond holders. Even though in this instance they're borrowing money from the U.S. government, the value of their bonds as they trade them goes down because the interest rates go up on them. And they're out loaning money all over the place. Because a lot of those institutional bond holders tend to be banks. So this is really more of protect the wealthy's money. And not only is that the dynamic, there is no evidence that PIMCO shorting bonds, because they anticipate inflation going up a little bit, but if they make 1 or 2 percentage points on this stuff, it's definitely worth it. So Washington Post reports there's one surprising group of people who's not terribly worried about the budget brinksmanship in Washington. Investors who lend the U.S. government billions of dollars. Now, according to Stockman, when inflation goes rampant, people are going to divest themselves of the dollars. And I'm like, well, what are they going to put their money into? Gold? You know, these major institutional investors, they don't buy reams and reams, or I don't know what, blocks and blocks of gold. The only other choice they have is to go into another currency. What currency are they going to go into? What currency? The yuan? They're not going to be able to do that overnight. They're not going to get the rest of the world to spend money in yuans. The euro? Are you kidding me? So all of this is really just about protecting the wealthy. Just keep that in mind. when you hear all this screaming about the debt and the deficit, it's the fear is that it's going to diminish the value of money for people who have a lot of money. Most people in this country, the vast majority of people, do not have money. It's not going to lose value because they don't have it. That's what they're doing. In the meantime, there's not even any indication that this PIMCO thing has anything to do with it. The U.S. government was able to borrow money for the decade at 3.5% on Monday. That's a 10-year Treasury bond, up from 3.4% a week earlier, but below February levels. In other words, there's no run. There's no running away from Treasury. They don't have to raise the interest rates enormously to attract these loans. PIMCO, the largest bond investor, disclosed over the weekend that its $236 billion total return fund now holds negative 3% of its assets in treasuries, meaning it would actually make money if treasury bonds decline in value. They decline in value, they raise their interest rates. Unless entitlements are not substantially reformed, the U.S. will likely default on its debt, Gross said in an April report. Not in conventional ways, but via inflation, currency devaluation, and low to negative real interest rates. In other words, well, it's not going to default the way that Glenn Beck tells you it will, and you'll have to use heritage seeds and freeze-dried food and gold bullion and trade with your neighbor. You know, I've got some gas for that cow. No, what he's saying is, but via inflation. In other words, there's going to be less value in those loans that you've made. Currency is going to be devalued. Yeah, that means that it's going to be more work for Americans as they export stuff to other countries because their exports are going to be cheaper. Low to negative real interest rates. In other words, you're going to lose value on your loans. The bottom line is, folks, this is rich people screaming about the chance that they may lose some of their capital and trying to make it seem like it's everybody's problem. Prices in the bond markets, the low levels of return that investors are willing to accept, suggest that investors broadly are not buying Gross's thesis for now. And finally, let me end with this. Ezra Klein has a post up showing a graph from the Congressional Budget Office in September showing that if we do nothing about the deficit and the debt, the budget comes roughly into balance over the course of the next 70 years. In other words, in about 70 years, we can start to run surpluses. The nothing in this instance means you need to do three things. One, all the Bush tax cuts expire, as they're currently scheduled to do. In other words, go back to pre-Bush taxation levels. Frankly, I think we should go further than that, but be that as it may. The Medicare doc fix is either implemented or its repeal is paid for over the next 70 years. In other words, the $300 billion that doctors are not receiving for their payments from Medicare, fix that so they don't have to inefficiently push those expenses onto the rest of us. And the Affordable Care Act is implemented and all of its spending targets are met and all of its taxes collected. That's it, folks. You can do nothing. But instead, we're going to see this as an ideological way to cut things like Social Security, things they've been wanting to do forever. Forever.